Start with the big picture. Partnership is a tax concept, but GP, LP, and LLP are mostly state law creatures. On the EA exam, they'll test that you can match the label to two things: who can manage and who is personally on the hook for debts. If you remember those, the self-employment tax result usually falls into place. A general partnership is the simplest. All partners are general partners. That means full management rights, but also unlimited personal liability for partnership debts. They're typically liable on a joint and several basis, meaning the creditor can chase one partner for the whole bill. Exam tip: a general partnership cannot have limited partners. If you see limited partners, you're in LP territory. Now, the limited partnership, or LP. An LP must have at least one general partner and at least one limited partner. The general partner runs the show and takes the liability exposure. The limited partners look more like investors, limited liability, and generally no day-to-day management. If a fact pattern says passive investor and not involved in operations, that's screaming limited partner. Here's where tax sneaks in: self-employment tax. General partners are treated as self-employed on their ordinary business income from the partnership, so that income is generally subject to SE tax. Limited partners usually are not subject to SE tax on their distributive share because they're treated like passive investors. But if a limited partner gets paid for services, like a guaranteed payment, that payment is SE income? That's a favorite exam twist. Limited liability also affects losses through basis and at-risk rules. Limited partners generally don't have economic risk of loss for partnership liabilities under state law, so recourse debt usually doesn't increase their basis the way it can for a general partner who personally guarantees the loan. Translation: limited partners often have less ability to deduct losses, and those losses can also be passive and suspended. An LLP is like a general partnership for management. Partners can actively participate. The difference is the liability shield. An LLP commonly protects partners from liability for malpractice of other partners. That's why you see LLPs with professional firms: law, accounting, engineering, architecture, medicine, depending on the state. On the exam, if everyone manages but there's a malpractice shield, think LLP. With regards to the Centralized Partnership Audit Regime, or CPAR, which statement is true? Is it automatic to elect out when you have fewer than 100 partners? Is CPAR only for partnerships with more than 100 partners? Or, unless the partnership makes a valid opt-out election, CPAR applies? Think about it. The correct answer is, unless the partnership makes a valid opt-out election, the CPAR audit procedures will apply. The tempting wrong idea is that small automatically means exempt. It doesn't. Size can matter for eligibility to opt out, but you still have to make a valid election. Otherwise, CPAR is the default. Unlike limited partners, general partners have what for a partnership's debt obligations? Think about whether the partner can be personally chased for the debt, and whether a creditor can go after one partner for the whole amount. Which phrase best matches that idea? Think about it. The correct answer is joint and several liability. General partners are personally liable for partnership debts and obligations, and a creditor can generally pursue any one partner for the full amount. A tempting wrong answer is limited responsibility, because people confuse it with limited partners, but general partners don't get that shield.